As Jerome Powell's tenure as Federal Reserve Chair draws to a close, markets are beginning to look beyond the familiar playbook that has guided monetary policy for much of the past decade. A likely transition to a Kevin Warsh-led Fed would represent more than a change in leadership. It could signal a shift in how central bank interacts with markets, balances transparency with discipline, and defines its own role in the financial system. Warsh has been a longtime critic of quantitative easing, referring to it as the reverse Robin Hood. In his view, large-scale asset purchases supported financial markets and asset prices far more than the broader economy, widening wealth gaps and distorting how capital is allocated. Warnings are no longer theoretical. Debt held by the public has already risen above 100% of GDP for the first time since World War II. Annual interest costs on that debt now exceed $1 trillion, consuming 20 cents of every dollar of federal revenue. Under a Warsh-led Fed, investors should expect fewer explicit rate commitments and less commentary designed to smooth over near-term volatility. A communication style would likely resemble an earlier era, less frequent, more measured, and intentionally ambiguous, encouraging investors to focus more on economic fundamentals, growth, inflation, and fiscal trends. The U.S. is not on the verge of a fiscal crisis, nor is the Treasury market at risk of losing its foundational role in the global financial system. For portfolio construction, this argues for flexibility and discipline. Fixed income investors may favor short to intermediate term maturities or selective tips, exposure to bounds, income generation, and duration and inflation risk. While elevated yields continue to offer attractive income opportunities, particularly for investors prepared to navigate a world with fewer policy promises and more genuine market signals. If you have questions about the stock market, bond market, or your investments, contact us today at Ox Road Capital.